Hey everyone, welcome. It is 1 o'clock. We just got the closing bell for Friday, February 2nd, and we got a pretty big day in the markets. We moved up quite a bit. This morning, I was saying how I was somewhat skeptical that we might reach all-time highs today. I thought it might be possible over the next few days or week, but it happened today. So let's see how everything looks now that we have hit those all-time highs. S&P 500 moved up very strongly and made that all-time high, pulled back a tiny bit from it, but it's still above the previous all-time high. I moved this psychological resistance line up from 490 to 500. So we could conceivably keep on moving up until this point, and then we'll see. Maybe it'll keep on going up, but we will reevaluate at that time. For now, it does look like that we will probably reach that. Maybe in a week, maybe in 2 weeks, but for now, that's what it's looking like. Let's QQQ. Again, it made an all-time high. So it did manage to breach this high. This high was 429.85. And today we made it to 430.24. We closed at 429.15, just a hair below that previous all-time high. So definitely stronger than I expected. And it looks like Apple probably just shrugged off all of the bad news from the earnings. It most likely got dragged up by the market rather than anything that had to do with Apple itself. We'll take a look at that in a moment. Let's take a look at DIA. DIA also all-time highs and moving up just very steadily along that EMA 8. So this market is still very strong. The trend is still going up, but we did identify some weaknesses this morning. And so I want to look around some more, see if we can find some more weaknesses. We see IWM. Okay, so here's a weakness right here. On a day where S&P 500, NASDAQ, and Dow Jones are all up and all making all-time highs, we've got the Russell 2000 small cap stocks, the most speculative of the growth stocks, sitting around and going down 0.5%. That is not happy. That is not congruence. And so we are just not seeing consistency within IWM. So that's a red flag. Let's take a look. Before we do that, let's take a look at Apple. I want to see what happened with Apple. So Apple did gap down. It has a huge green bar right here. So after earnings, we didn't like it. We gapped down. We gapped down to, what is this, open 179.86. So I think it was yesterday we were talking about, hey, don't buy puts in Apple because it would have to move at least down to 178 just for you to begin to make money. And then it'll have to keep on going lower in order for you to make money. So 178 was just the break-even point. So we never came close to 178. The low was 179.25. So even if you sold right at the open, you would have lost a little bit of money. And if you held all the way to the close, you would have lost a whole bunch of money. So we tend not to like to play straight calls or straight puts the day before earnings because you're overpaying. The implied volatility is so big, you're overpaying for those options because that volatility is going to go way down. One of the components inside an options price is volatility. There's the underlying price, there's interest rates, there's volatility, and a couple other things, time decay. So those all figure into the price of an option. Usually the biggest components are the underlying price, sometimes a time decay depending on where you are near expiration, and then the next one is implied volatility. So I said that backwards. It should be underlying price, volatility, time decay, interest rate. So by far the biggest are implied volatility and the underlying price. So if I have a huge spike in implied volatility and I'm buy when that implied volatility is high, when that implied volatility collapses down, I'm going to lose a whole bunch of money. Maybe I should demonstrate that. So if I go over here and I say, if we're looking at Apple, and I'm looking at this March expiration, let's just look at the money call. So 190 at the money call, let's just say it's at $3.50. On Monday, if the price doesn't change at all, no price, but we go down just 10% in volatility, Let's just say, because that implied volatility collapse from Apple yesterday was at 70 something percent. Today is at 20 something percent. So we collapsed over 50%. So let me show you what a 50% collapse in volatility looks like on no price change. So that we would go from $3.50 down to, has zero. Theoretically zero. Let's choose the 185. Okay, 185. Today worth $6. On Monday, if price doesn't change at all and we collapse 50% in our volatility, it becomes 58 cents. So it's a huge impact on our option price right here. So that's the equivalent. Let's just say if the volatility didn't change, how much would the underlying price have to change in order to get us to that same 50 something cents? So I have to go down maybe like $18. Yeah, almost $18. So 17. Yeah, $17 gets us to 53 cents. So my price can move nothing and drop 50% and I'll go down to 50 cents, or my price could go down $17, which is almost 10% change in the underlying price. And then we hit 50 cents. So the implied volatility is really important. And we never want to buy options when volatility is really high. We want to be selling options if you have that option in your account, or you have that ability in your account. So Apple got dragged up by the exuberance inside the overall markets, and we want to see if it's warranted. So far, we see that IWM didn't follow suit. Small caps did not follow suit. That's a red flag for us on top of everything that we identified this morning. Let's take a look at VIX. VIX is flat. Zero, exactly the same as yesterday. So when a market moves large, so this is specifically on the SPY, and let's take a look at the SPY. The market went up quite a bit, 1%, and made all-time highs. VIX did not go down at all. And that is unusual. So that is a divergence right there. We would expect VIX to collapse back down if we were overly exuberant. So that means the options market makers, they're not celebrating this new high. They're just saying it's the same as yesterday. We feel the same today as we do yesterday. We're not any more fearful or any more exuberant than we were yesterday. And what did yesterday look like? Well, yesterday was up, but it was just kind of this baby evening us out, undoing the FOMC. And now we're at all-time highs. No change in status. So the options market makers, they're not getting excited about this move upwards. Let's look at our bonds. So yesterday we were talking about how we went parabolic on the bond prices. And I was saying, okay, well, this is what happened last time we went parabolic. We went sideways and we came down. We went parabolic right here. We came down to the EMA 8. Well, we went parabolic right here, and in one day, we went back down to the EMA 8, MA 50, and MA 200. So we're at a very important level right here. I want to see if this MA 200 holds. If we break below, we're sitting right on top of it. We closed at 96.08. The MA 200 is at 96.06. We're only 2 cents away from that MA 200. If we break down next week and go below that MA 200, that's probably a good time to start buying puts in TLT. So if I forget, someone remind me. We'll take a look at potentially buying puts or going short TLT. We'll do a option strat example of a trade and see how it works out. But that's only if we break below that MA 200. For now, we're just sitting right on top of it. But this is also not boding super well for us to continue to make new highs for an extended period of time. It could happen for 1 or 2 weeks, but then we're going to expect another pullback, or if we finally get a deep enough pullback or a correction, then we'll get that, and then markets can resume. Then IWM, small cap stocks, can start leading. The tech and the discretionary can start leading again, instead of, I don't know what we had today, probably an overexuberance of tech, but we can look at the sectors in just a moment. This TLT, why did that come down? Partially because of that employment report that we talked about this morning. So if a whole bunch of people are employed way, like more than double the earnings of what we were expecting, then that is inflationary because you have a population with more money on its hand and probably going to be spending. Americans like to spend. They don't like to save. So if they're getting into more money, then they're spending more money, and that is inflationary because they're chasing the price of goods upwards. Also, what was not specifically stated in those reports, but what is having a big effect, if you read a little bit deeper into the situation, that payroll number, the fact that people are making more money is partially due to several states raising their minimum wages. At the beginning of 2024, new laws went into effect where minimum wages went up. So we now completed our first month in 2024. People are getting paid a little bit more. If I have wage inflation due to a moving up of my minimum wage, well, if my minimum wage moves up, suddenly the guy who's making minimum wage is making the same as the guy who used to make more than minimum wage. That guy's going to start demanding more money too. And then businesses, in order to afford all these raises for everyone, they're going to raise the price of their goods. And you've got people with more money chasing those goods upwards. So now you've got a very inflationary environment. So that's not good news for interest rates. It's not good news for the Fed, who wants inflation to come back down. And that's not good news for rate cuts going forward. So we would hope that TLT would be coming down because that reflects a rational market. So these last few days, that last week was completely irrational. And now we're seeing some rationality, but I really want to see it come below that MA200. And I want to see these rates come down. Okay, so yesterday we were at 38%. We were confused because the FOMC minutes came out, or the announcement came out, and we're like, well, it should be going down, but it was still at 38%. And now it was at 30% a couple days before, and then went back up to 38%. Now we're down at 20%. So now we're starting to get some rationality inside of these expectations. Although if I look forward, I'm sure I'll still find plenty of irrationality. So, well, I mean, a rate cut some point during the year is expected. Is it going to come in May? Maybe. That's a little too far off for us to evaluate at the moment. It's not as clear as before, where we could call several months ahead of time that this March number was crazy before, because it was way back. It was like 80 something percent, right? Almost 90% at one point. So it was very obvious that the probabilities priced into the markets were messed up. May is less clear because the inflation picture is changing. But if this employment situation continues and we keep on raising everyone's wage, eventually, well, and not even keep on, the wage happened. The minimum wage happened, and it's going to take a while for all these people with more money to start chasing the prices upwards. So there's going to be a delayed effect in that. And also there's going to be a delayed effect in the demand of people who were above minimum wage, but now are at minimum wage to start demanding that their wage goes up as well. So that's all going to take some time. So that employment report is indicative of future inflation, not immediate inflation. And that's bad news for the Fed, because we were like, oh, we had all these beautiful signs that inflation was beginning to come down and they were beginning to consider rate cuts. But now they've got to take a look at this and go, oh, maybe not, because they have a dual mandate for unemployment and for inflation. And this kind of throws both of those matrices off kilter. It's undoing some of the work that they've been doing by raising rates. So I would expect these probabilities start coming down as well. If I was in the Fed, I'd be like, oh, this employment report is not great. We really need to watch and see how this is going to play out for a few months before we start considering whether or not we should cut So this TLT picture and this Fed watch, or the what's priced into the market, is not looking very good for long-term continued upward movement. It really does look like we do need that pullback or that correction before these markets can resume a really exuberant bull market. And then the later it happens, the worse news it is for us, because then we're going to run right into elections. If it happens sooner in the year, at least we'll get a nice few months, several months of bull run before we hit the election cycle. But if that deeper pullback or that deeper correction comes in March, April, May, well, you only got a couple months of possibility for it to, because it'll take probably a couple months to play out and then start moving upwards. And then you get stuck in the election cycle. You get chopping sideways until you actually get an announcement, or it becomes more and more clear to the market that one candidate or the other is going to win. Right now, we don't even know who the candidates are. So the sooner we can get that correction or pullback, the healthier it is for the markets. But for now, it doesn't look like it's imminent. We've got at least probably 1 to 2 weeks of approaching another set of new highs, another set of psychological resistances before we're going to get that correction or pullback, potential correction or pullback. No guarantees. So the same principle that we've been operating on the last couple of weeks, which is we are still in an uptrend. We don't want to bet against that trend. So our portfolio is mostly leaning to the bull side with some hedges in place. That still in operation. You're going to see this move upwards. Take profits in your tech sectors where you can, is my opinion, and then hedge yourself, especially in the tech sector. And these remaining opportunities for upward movement, we're going to reserve for the more conservative sectors, which is a good time to actually take a look at those sectors. So I'm more interested in the last week or two. Let's look at 2 weeks. Energy at the top, staples at the top, along with communications and retail. Real mixed bag. Right? Those sectors don't really belong next to each other. Staples is getting really, really strong. Yesterday, when we looked at this 2-week number, staples is way down here. Today, when we look at the staples number, 2-week number for staples, we're way up here. That's a huge movement in a single day. So staples is getting a lot more attention. Insiders, institutions are starting to feel the same way I'm starting to feel, it looks like. Whereas we better start getting a little bit cautious and see what is going on, because it's feeling like we're going to roll over pretty soon here. Of course, any new news could undo that, but there's no real strong news anymore. We're in the middle of earnings season. We're going to see how the rest of these earnings play out. And that is probably going to be the impetus for us to continue moving up towards this new psychological resistance. And after that earnings cycle's complete and you have nothing to stimulate or push the markets up anymore, what's going to guide the market is the underlying feelings of the institutions inside of the market. And right now, what we're seeing is that they're feeling defensive. So this can continue through earnings season. And unless new stimulus, new news comes out, we don't have another Fed meeting until March, end of March. So we've got 2 months of this kind of vacuum of really big potential market moving news events. And in that vacuum, it's going to be the underlying emotions of the institutions that's going to take over. So I could be wrong, because there could always be new news items that are coming up and inserted in between now and then. But if nothing else, all else equal, like no new news comes out, that's really what it's looking like right now. The current, and of course the sentiment of the institutions could change during those 2, 3, 4 weeks as well. So, but right now, as of right now, the underlying feeling of the institutions is, hey, we better go defensive. And if that persists, through earnings season until earnings season is over and we have no new news events, then this market is going to start rolling over. Okay, sectors. Let's take a look at today's sectors. What happened today? So XLC, as expected, because of Meta, and Amazon would XLY. So those two together, and then Apple had this amazing recovery. So these two make sense that they're at the top. XQQQ, XLK, we said those were very strong. We were expecting them to be at top. But what I want to see is what else is at top and what else received attention outside of that. And then I want to see specifically what happened to the defensive sectors. So the Dow is up. That's more defensive than not. So even though the tech stocks went up, the Dow Jones went up with it. We said, it made all-time highs. And then we want to see staples down a little bit. So not as doom and gloom as we were feeling a little bit before, and healthcare is flat, 0.06%, up 0.06%. So that's interesting. So we didn't take money out of XLV. Maybe XLP lost a little bit of money. Let's take a look at the specific stocks within the staples. So today, Clorox up 5.3%, Dollar Tree up 2.6%, Target, Costco all up, Walmart up. So this is still feeling quite defensive. The ones that are down, so what happened is there's more total number of stocks within the staples that are down, but they're not down nearly as much as the ones that are strong are up. The weakest one was down 2.49%. That's Walgreens. And then next was Church and Dwight, which is 1.8%. And up here, we've got 5.3, 2.26%. So I would say that these are just the ones from about 0.08% to about 0.5%. Those I would just call noise. Those are mostly flat. And so we have a roughly equal number, well, maybe slightly more that are down than are up. And then, of course, the ones that are up a lot more than the ones that are down. So overall, I wouldn't call this super negative. There's still interest moving into the XLP sector. I'm going to take a look at their chart. I know we watched this yesterday, and we've got a little bit of an indecision bar right here on large. Okay, so this is interesting. We have an anomaly within. We have a differing picture coming from volume and from price. I have a huge amount of volume that is sales volume. They're showing me a red bar right here. So they're saying there's a huge amount of selling, meaning that the transactions that happened toward the seller side, or favoring the seller rather than favoring the buyer. So meaning that sellers were in control. They say, hey, if you want to sell to me, you've got to come to my price. I'm not going to come up to your price in order to get that sales transaction. So people were willing to come to the seller's price in order to get to the transaction. That's why these are red. And on that day, we have a completely flat 74.19 open, 74.17 close, basically the exact same level. We have a flat candle right here. So basically price didn't move at all on a large amount of downward selling. That is a change in this large green bar with large green volume. So that's indicative of potential change, potential pullback in the XLP, which kind of makes sense if we're going to start paying attention to QQQ for the next couple of weeks. Then we lose attention in XLP. So what I want to see next week is, if this does pull back, does it pull back beyond the EMA 8? If it doesn't, it just pulls back to the EMA 8 and keeps on going up, or even the EMA 20, but I really prefer the EMA 8. If it comes and it just travels along that EMA 8, then I know that institutions are still highly interested in staples. And then if that persists through earnings season, then we're going to know that we're pretty close to the end. If we pull through to the beyond the EMA 20, we pull back to the MA 200 or beyond, then different story. And then we would say, okay, well, renewed interest. The sentiment of the institutions has changed again. But right now, the sentiment is safety and defense. And if we're just going to look for signs of that continuing or of changing, what this is telling me is maybe we're going to consider changing, but it hasn't happened yet. If we just keep moving along that EMA 8, then that sentiment has not changed. So we got a pretty deep look into some of the forces that are pushing the market right now. We are up for now. The QQQ, the SPY, we're all moving along these trend lines right here. So our expectation is that we will continue to move along it for at least 1 to 2 more weeks. And then when we hit those new psychological resistances, for example, in the SPY, that would be the 500 level. When we get near there, then we reconsider everything all over again. So for now, we're going to continue to lean positive in our portfolios. We're going to continue to have our hedges, although right now you could conceivably consider taking off your hedge and then putting it back on. We're almost right back to that +3 ATR. So I guess for 1 or 2 days, you could consider removing that hedge and then putting it back on when we start following these +3 ATR levels again. I don't know. It's probably not worth, for me, it's not worth the transaction cost or the headache of having to think about, oh, I might not have protection for these few days just to save a few pennies or a couple dollars on my hedges. So I would probably just leave them in place. I would need to look at my portfolio specifically before I made that decision. But the overall feeling is, is insurance. I was planning on losing that money anyways, but if everything continued along this trend, I was 100% prepared for those hedges to go to zero and not have a huge impact on my portfolio. So is it meaningful for me to go in and out, to have the headache, the brain processing power, the transaction costs of exiting and then going back in later? Most likely not. That was money I was prepared to lose. I just bought insurance. I was prepared to pay that premium and just forget about it and be done with it. So it's probably not worth it for me to go and say, oh, I'm going to take it off and put it back on. Just leave it in place until that hedge does not look like it's protecting you enough anymore. Then you go into it, you either add another hedge or you roll your current hedge into another hedge that does provide you the protection that you need. Because remember, as you're losing money on that hedge, you have time decay, you have premium decay. So as you're losing money in it, it's protecting you less as well. So every once in a while, you do need to look at your hedge and refresh it. And we've had it on for about a week. Maybe it's time to take a look and see whether or not we need to refresh it. But when it's moving, when we're expecting it to move up for another week or so, not the most pressing matter to be taking a look at renewing my hedges. It will become more pressing as we reach these psychological resistances. Okay, so that's it for today. We've been talking a lot. I think I've been talking a little bit faster than usual as well, trying to get everything in, all my thoughts out before I lose them. But just keep on expecting that this market looks like it's still following the trend. It's still very strong. But we do want to keep our hedges, or we do want to continue to think about hedging as we move higher in this process, because, well, let's do one last evaluation. I want to see in the S&P 500 and QQQ what 30% looks like from the bottom. I need to change my scale here so I can get to it, because that will be another very important sign of where we might stop. 30% is actually quite high on the S&P. So it's about 525 level. So I'll draw a line right there. Okay. It takes us pretty close to the implied move that we had earlier this year. And then QQQ. Okay, 30% would be about the 440 to 445 level. I'll just put it at 440 for now, which is a lot closer than the level on the S&P. So S&P I should probably be doing at 25% instead of 30%. I can go back and correct that later. This is the line that we're going to be looking at for the QQQ. So we could keep moving upwards like this for a couple weeks. And then we're really going to want to make sure we reevaluate if we haven't fallen through this trend line before then. So a lot on our plates today. Hopefully you were able to follow. If not, there will always be the replays available on YouTube, and you can go through it at your leisure. So have a wonderful weekend, and everything's still looking good. Hopefully, if your portfolios are leaning positive, you should still be doing very, very well. I hope everything is looking very profitable for you, and I'm helping keep you out of trouble. So have a wonderful weekend, and I'll see you guys on Monday.